Hello, Mark Sturdy here with 7 days ahead's highlights of our analysis this week's 22nd of March 2022. Let's just go straight to the summary. It's pretty much unchanged from last week with one quite dramatic difference, which is the gold. We're now bulls of gold across the time frames of long, medium and short, and I'll come to that in a moment. Let's just go through to the currencies first of all. We have been bulls of the dollar and we remain bulls of the dollar, and the best example of that is the yen, in the grip of a large continuation bull wedge. Shorter term patterns providing good support on pullbacks. For example, this rising wedge provided good support on the pullback here. But in the last week, it's been quite dramatic. We were bullish of the dollar against the yen, and sure enough, it pushed on again hard. It is just worth reporting that whereas we were excited for sterling with the possibility of a breakout of this trading range, of course, breakouts on monthly charts only matter on the end of the month, so we have another week or so to go. It doesn't look as if that breakout's going to happen, indeed. And there was nearly a day key reversal here. Altogether, it looks like basically sterling's fallen back into a long-standing trading range against the euro from 2016. And being at the top of that trading range, of course, the presumption is that sterling is vulnerable to weakening against the euro. Moving on then to the stocks, let's look here. If you remember last week, we had lost our bearishness and we'd gone flat on everything but the Nikkei. We thought the Nikkei looked in good form, and we remain excited by the Nikkei. We're also interested in the FTSE, but because the long-term structure of the FTSE is not at all clear, whereas that of the Nikkei is clear, giving you a full straight run of bull signals. Let's go back to the Nikkei and see what we're talking about here. Here's the very long-term pattern I've talked about many and oft. The pullback was a pullback to the support from this very long-term neckline, which would expect to be strong and intact, and it has remained strong and intact. The market came down and bounced off it with alacrity. Now, there is resistance up here, 26,850, that cautious bulls might want to wait for a break of that overhead resistance. In fact, that may or have already happened in the June contract. June contract here, it's pushed up through. A close on the week above 26 and 490 would be a good break on the week as well. Worth noting, over the week, this dramatic move, the best move of all the currencies against the dollar, there was a nice piece of price action here. Altogether, very bullish. 3 days of quite fierce moves, breaking these horizontals, breaking the falling diagonal, and breaking the medium term horizontal here. If we close up here, very good additional signal for the Nikkei. Moving then to the bonds. The summary of the bonds is that we are bullish of yield, bearish of price across the whole board. There's a slight question mark over the gilt short term. Maybe that should be flat. But just as an example, the lead bond market, here we have the long-term chart of the T-note, breaking this long-term resistance, yields rising, pulling back, finding support there, pushing up through the prior high 177. This is how bull trends are structured. Prior highs are being supportive. Let's look at the medium term to show that. So the bull trend forms a triangle, the prior high acting as support once, twice. It's a bull trend in good fettle for higher yields. In price terms, the pause at the very beginning of the war led to a retracement in price. Once, twice it tried to break this resistance and failed, and now the bull trend has gone beneath the prior low, and a new bear price leg, bull yield leg is in progress. Commodities. Oil, we think, is in a position of no great clarity in this respect, that it's found this sort of trading range area here up at 115 or so. There is an argument that this is a big head and shoulders reversal, in which case there's a good deal further to go for oil up to 150 or so. It's not a perfect head and shoulders reversal, worth bearing in mind. Certainly we would think oil was a buy were it to come down to the mid-80s, below 90. Both this neckline and this prior high would be good buying levels. It feels as if there's no great force acting on the oil at the moment. The volatile, ranging price action suggests nothing easy to go for here. But gold is a different matter. Gold is exciting. We know the market got up here in 2020, and the prior high of 915 formed back in 2011. And since then, the market's drifted and gone sideways. In so doing, it found support at the prior high 1704, once, twice, three times bounced off it, showing good underlying buying. As it moved sideways and bouncing off that prior high, it's created a double bottom. In the last 3 weeks, that has now emphatically completed by pushing through 1919. Of course, such is the volatility being that it went up to the prior high, naturally a point of reference, came down, and is now back on 1919 or so. Let's go into the... We think the market is a buy here. There should be good support. If the bull pattern that we think exists does exist, we need a close on the week above 1922, 1919. If we get that, it would feel like good buying levels here because it would suggest that the double bottom is intact. As regards the day chart, nothing. These supports didn't hold in the pullback. Interesting for those that refer to Fibonacci, it was exactly a 61.8 retracement which we bounced off. That's it. Thanks very much.